to quickly go over the gap fill strategy from my book, 7 Trading Systems for the S&P Futures. And I'm going to show you some crude oil strategies from algorithmic trading systems. Going to cover E-mini crude, Brent, West Texas, as well as regular NYMEX crude. But look at the gap fill strategy. This is a strategy from book S&P Trading, 7 Trading Systems for the S&P Futures. Again, you can find that on my site by going to More. And then it's the second book listed here. It's also on Amazon. And you can get the software from us directly or the ebook. And this is with slippage and commission. Not great results with that if that were not with slippage and commission, but since slippage's commission is used at $25 round turn, you see the results here. And this was designed in, this book was released in July of 2010. So right in this time frame is when the book was released. And so you can see the walk forward results with slippage and commission. Really strong equity curve here. Then it had a pullback for a while, and so sometimes that happens in trading systems where you can actually have a pullback that lasts for a couple of years, and then now it's in a strong equity curve, mean reversion. There's a lot of mean reversion. So one of the things we have it on our list to do is to test this against a low VIX. When VIX is low, does mean reversion work better on gap fills in the E-mini S&P? So that's the gap fill one from the book 7 Trading Systems for the S&P Futures. I wanted to show you that real quick because I had a trade today. And understanding gap fills is important to understanding our next book. Our next book is Algorithmic Trading Systems. I have another book here too, but I'm going over these today because I have a webinar on this book on Wednesday. And so I'll tell you where you can sign up for that webinar here in a minute. You can go on my website, find the book here, and then you can go here if you would like. It takes you to its own website. You can download the ebook, and then you can get the membership site, or you can get the book on Amazon and then get the membership site. But the strategies here, I want to show you NYMEX crude, and we're going to take a look at that. Here are the results. Let's see this. Let's see, do I have slippage and commission in here? No, there's no slippage and commission. And you see the results going back. This is with the time frame going from 10:30 to almost the close as far as taking entries. In the book we went 10:30 to 11:30, and it has a lower drawdown if you do that, but this is the one we trade because it trades more frequently. And so you can see the results here, $111 average trade profit. If you don't want to trade the big contract, you can trade the small contract, and it has about half the results, about half the net profit, about half the drawdown, and about half the average trade profit. So let's see, 989 trades versus 1,015, so almost the same number of trades. And so the point value is a little different. I'm going to show you the matrix on these in a minute so you can see the difference, but also we take a look at West Texas Intermediate, and you see the West Texas Intermediate has the same point value as NYMEX, and here's the equity curve, same parameters, and click on Brent crude, and same parameters, nice results, highest average trade profit, lowest drawdown. So you want to think about trading West Texas and Brent, which I don't trade at the moment. Those are on the ICE exchange, and you can see the results in those as well. And again, these three, crude, NYMEX, West Texas Intermediate, and Brent, all have the same point value. And then this is the mini NYMEX crude. Based on the CL symbol, it's half the contract value, and so the results included half the stop loss. Put the stop loss at half the amount, and I'm going to show you the matrix for that so you can see the difference in point values. So you can get this order matrix by clicking on the trading apps on the left, and you can see that every tick in the crude oil contract is $10, and there is one tick per penny. And so if you buy it at $52.70 and it goes to $52.80, you made $100. If you bought it at $52.70, it goes down to $52.60, you lost $100. Same thing in at QM, but there's not as many ticks. It's 12.5 points per tick. So between $52.60 and $52.70, there's only 4 ticks, while between $52.60 and $52.70, there's 10 ticks. And so even though the point value over here on QM is less for the dollar amount for $1 move, it's half the amount. The point, there's only 4 ticks every 10 cents, while over here there's 10 ticks for every 10 cents. So it's $10 per tick. Over here it's $12.50 per tick. And so that can make a difference in the slippage and also the commission, because effectively you're paying twice as much commission even if your commission rate is the same, um, depending on your broker, because the point value in your average trade profit is about half the amount. And so if you have less capital to trade with, want to reduce your risk, you can trade QM, but it's more efficient to trade CL, and it's a bigger, more liquid contract. You get a better slippage and commission numbers per contract, per unit value if you trade the CL contract. So that is a little spill on that. And so we've got a webinar on Wednesday at 4:30 going over this actual pattern that we're talking about. We're talking about the gap fill and reverse pattern from our book in chapter 6. And I'm going to show you the link for that. You go to pull this window in here, Twitter feed. You can go to my Twitter feed if you want. It's one way to find it. Also, it'll be in this email or web page depending on what you're looking at. Twitter feed, and you click on this link, and it's a TradeStation webinar. TradeStation is hosting this webinar, and I'm presenting at this webinar. And it's Wednesday at 3:30 Central, 4:30 Eastern. Click on this link, and you can register. And you can see here it's gap fill and reverse crude oil. And I'll be going over this, and you can sign up here. And I hope to see you there on Wednesday.